Nebius grew revenue 5 times year over year, but paid-in capital jumped $5 billion in 6 months, and stock-based comp is up nearly 600%. So the per-share math is not as clean as the headlines. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Nebius Group gets graded and traded. All right, on the top line, revenue came in less than 1% ahead of estimates, basically in line. But the year-over-year number is where the story is. Revenue grew 454% to $582 million. That is not a small company anymore. And on EPS, the surprise was plus 85% versus estimates, which is a huge beat on the bottom line number analysts were modeling. The GAAP net loss looks ugly next to last year's profit, but last year had a nearly $600 million one-time gain from an equity revaluation. Strip that out, and the underlying picture is much cleaner. So on the beat itself, this earns a B. Revenue was basically in line with estimates, but EPS smashed the number by 85%. That mix. A small revenue beat with a monster EPS beat is a solid print, not a jaw-dropper. And on consistency, this earns a C. Nebius is still early in its post-restructuring life as a pure AI cloud name. The track record of consistently beating estimates just isn't long enough yet to grade any higher. Let's talk about the positives from the report. Revenue grew 454% year over year to $582 million. That is AI cloud demand showing up in the numbers as new capacity comes online. This is the growth story bulls have been waiting to see land. Adjusted EBITDA swung from a $21 million loss a year ago to a $236 million profit this quarter. That is the business crossing from investment mode losses into real scaled profitability, and it's the single most important line on the whole report. Deferred revenue, which is customers prepaying for future cloud usage, ballooned to nearly $6 billion, up from about $1.5 billion at year-end. That is nearly a 4 times jump in booked backlog, and it tells you these are multi-year AI contracts already signed and paid for. Operating cash flow flipped from negative $168 million to positive $2.25 billion. Now, a big chunk of that came from customer prepayments, so it isn't a normalized run rate. But even stripping out the working capital swings, the underlying cash generation is about $1 billion in the quarter. And the operating leverage is showing up. Selling, general, and administrative expenses dropped from 65% of revenue down to 30%, and product development went from 41% down to 33%. Revenue is scaling way faster than the cost base, which is exactly what you want to see in an infrastructure build-out. So on profitability, this earns an A. Adjusted EBITDA flipped from a loss to a $236 million profit, and the cost ratios are compressing meaningfully. That's the transition quarter that changes the entire investment case. Now, let's talk about the negatives from the report. GAAP net income flipped from a $500 million profit last year to a $190 million loss this quarter. That looks jarring, but last year's number was inflated by a nearly $600 million one-time gain on an equity revaluation. Strip that out, and the underlying picture is a modest deterioration driven by financing costs, not operations. Interest expense exploded from about $5 million a year ago to $119 million this quarter. That's a 25 times jump. Non-current debt is now $8.5 billion, up from about $4 billion at year-end. The balance sheet is being stretched hard to fund the capacity build-out. Stock-based compensation jumped from about $15 million to $102.5 million. That's a 597% increase. It's now running at 14% of operating expenses versus 7% a year ago. That is real dilution pressure landing on existing shareholders. Capex was $5.2 billion in the quarter alone, up more than 1,000% year over year. That is roughly 10 times quarterly revenue being spent on infrastructure. Once you net that against operating cash flow, free cash flow is deeply negative, about negative $3.5 billion for the quarter. And on top of that, additional paid-in capital rose from about $2.33 billion to $7.4 billion. That's roughly $5 billion of equity issuance in 6 months. Combined with the stock-based comp ramp, per share value creation is running well behind the absolute business growth. On guidance, this lands at a C. The press release didn't include forward revenue or EBITDA numbers, so this is reduced visibility, not evasion. I expect them to address forward guidance on the earnings call. And on red flags, I'm at a C. The operational story is fantastic, but the financing stack is the thing I can't dismiss. $8.5 billion in debt, $5 billion in fresh equity issuance in 6 months, and free cash flow still deeply negative. That combination is a real risk if anything hiccups in customer prepayment cadence or capex timing. Putting it all together, this was the transition quarter bulls were waiting for. Revenue up 454%, adjusted EBITDA flipping to a real profit, and nearly $6 billion of prepaid backlog says the AI cloud demand is genuine and durable. But the financing stack is the other side of the coin. Massive debt, heavy dilution, and free cash flow that's still deeply negative once you subtract the capex. I'm giving this print a B-. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. The operational print really does validate the AI cloud story here. Revenue up 454% year over year, and $6 billion sitting in deferred revenue backlog. That's real demand, not just hype. If I'm starting fresh with cash secured puts on this name, I want strikes meaningfully out of the money. This is a high volatility growth stock, and I want breathing room against a financing news gap, not a tight premium grab. If I'm buying shares outright instead, I'm sizing small and staggering my entries. The ongoing equity issuance and the capex funding risk means I don't want to be all in on one print. So my play is to sell wide cash secured puts and stagger any shares I add. When I sell cash secured puts on this name, I only pick strikes I'd genuinely be happy taking assignment on. The balance sheet leverage means I can't chase premium and hope it never gets tested. My strike floor is sitting well below the current price. I want to survive a scenario where debt markets tighten or a capex delay forces another equity raise and the stock takes a real hit. For my ceiling, I'm not going any closer than a level where I'd be comfortable owning shares through the next capex cycle. In a risk-off tape, I'm getting put whatever I sell, so I have to mean it. So my approach is simple. I sell strikes I would truly own. This print tells me to keep holding my shares. Adjusted EBITDA turned positive, and there's $6 billion in contracted backlog. The story I bought is showing up in the numbers. The operating leverage is also real. SG&A as a share of revenue dropped from 65% down to 30%. That's the kind of move that tells me the business is actually scaling, not just growing. The only reason I'd trim is if my position has grown outsized from the run. The ongoing dilution from equity issuance and share-based comp is a real drag on per-share value, even as the business itself scales. so I'm holding, and I only trim if the position got oversized. The operational strength here tells me I do not want my shares called away cheap. The fundamentals are accelerating, not decelerating, so capping my upside at current levels doesn't fit the setup. If my covered calls are near the money, I'm rolling them up and out. This print gives me no reason to leave a ceiling right where the stock is trading, so I want more room and more time. If my calls are already deep, out of the money, and expiring soon, I'm just letting them run. The premium is doing its job, and there's no real threat to my shares from that strike. So my move is to roll near the money calls up and out. This print strengthens my LEAPS thesis. $6 billion in deferred revenue and adjusted EBITDA profitability tells me this is a scaled business now, not just a story stock hoping to grow into itself. I'm holding the LEAPs I already own. If any of them are deep in the money, I'll consider rolling strikes up to lock in some gains while keeping my long-dated exposure to the trend. The main risk to my 12 to 24-month thesis isn't operational, it's financing. So I'm watching for equity raises or debt refinancing headlines that could pressure the stock even while fundamentals keep improving. So I'm holding my LEAPs and watching the financing news. The release really does validate the original growth story. Revenue up 5 times year over year, EBITDA positive, backlog exploding. On operational grounds, averaging down here is defensible for me. Before I add, though, I have to weigh the dilution reality. Shares outstanding and paid in capital both rose materially in the first half, so per share value is running behind the absolute business growth. That's why I'm adding in pieces, not one lump sum, and I'd rather do it through cash secured puts at wider strikes than by buying shares outright, because that way I actually get paid for the volatility. So my plan is to add through wide cash secured puts in pieces. Bottom line, this print earns a B- from me. Nebius crossed into real scaled profitability this quarter, but the financing risk is the thing I'd watch every single quarter from here. Thanks for watching, and I'll see you on the next one.